This module, the second of the section devoted to the IFRS framework, discusses the conceptual framework, a document issued by the IASB in 2010, and one which you will find at the very beginning of any published collection of international financial reporting standards. When mentioning the conceptual framework in the previous module, we stated that this is a set of generally accepted theoretical principles that guide the bodies that design financial reporting standards and help users to apply them in practice. Before we go any further, let's note that there are two main approaches to how financial reporting may be designed and regulated: the principles-based approach and the rules-based approach. Under the principles-based approach, the goal is to lay down the general principles that should universally govern financial accounting, making a link between the objectives of financial reporting and those general principles. A good understanding of the ultimate objective of financial reporting, which is to provide meaningful and reliable financial information, guides preparers of accounting standards, financial reporters, and all users of accounting information in the design and interpretation of particular standards. It is important to realize that international financial reporting standards are created using the principles-based approach, with the conceptual framework, the topic of this module, providing those crucial general principles and objectives of financial reporting. At the other extreme, the rules-based approach can easily be compared to an accounting cookbook with detailed regulations which all companies must uniformly follow and which leave very little space for independent interpretation. This approach is widely applied to the design of financial reporting regulation in the United States, but it is also the principal method for formulating tax rules, which naturally need to be very precise and clear of interpretational inconsistencies. So it is therefore perfectly possible for part of the regulatory framework in which a company operates to be principles-based, while another part, for example that related to taxation, to be rules-based. We now know that international financial reporting standards are built around principles, with the conceptual framework providing the foundation for this approach. So let's examine the main advantages of having a conceptual framework and following a principles-based approach. Before we start, we should note that the advantages which we will be listing in just a moment may easily be rephrased as disadvantages of the rules-based system. The principal arguments for having a conceptual framework are: even if some events, transactions, or issues are not specifically addressed in the standards, a conceptual framework provides meaningful guidance on how to deal with them, allowing preparers of financial statements to develop suitable accounting solutions that are rooted in the principles that underpin the chosen approach to financial reporting. With the increasing complexity and growing unpredictability of global business, this is arguably the single most important benefit of having a conceptual framework. As a consequence of the first point, having a conceptual framework helps avoid firefighting, a practice of developing accounting standards in response to specific situations or issues. If standards are created in this way without being based on a set of guiding principles, they may easily become inconsistent and incapable of dealing with new types of transactions or even slight modifications to existing ones. Accounting standards based on a conceptual framework are thought to be more difficult to circumvent. Having a clear view of governing principles enhances the credibility of financial reporting and the accounting profession. And finally, with transparent principles laid down, it is less likely that the standard setting process will be influenced by vested interests or lobby groups. We have already said that the conceptual framework for financial reporting is an actual document which has been approved by the IASB. On the one hand, this document defines its most important goals by stating to whom it may provide guidance. On the other hand, it also specifies the areas in which such guidance is provided. Let's start by exploring the stated recipients of the framework's guidance. The goals of the conceptual framework are to help the IASB in its task of developing future IFRSs and reviewing the existing body of standards, to help the IASB promote harmonization by reducing the number of alternative accounting treatments permitted by IFRS, to help national standard setting bodies in the development of national standards, to help those who prepare financial statements in applying IFRS and in dealing with areas where there is no relevant standard in place, to help users of financial statements in interpreting the financial information which they encounter, to help auditors form an opinion on whether financial statements conform with IFRS, and finally, to provide information to all parties who may be interested in the work of the IASB. As you can see, the overarching objective of the framework is to provide help and support to the various stakeholders who come into contact with financial statements prepared under IFRS. From a formal perspective, it is important to realize that the framework, although accepted by the IASB, is not itself a standard. It does not therefore override any of the standards, and in the rare cases where a conflict might occur between it and a specific IFRS which prevails over the framework. Let us now turn to the four main areas for which the conceptual framework attempts to provide guidance. These are the objective of financial reporting, the qualitative characteristics of financial information, the definitions as well as the recognition and measurement rules applicable to the principal elements of financial statements, and the concepts of capital and capital maintenance. In the remainder of this module, we will be focusing on just the first area, leaving the discussion of the remaining three for the other modules within this section. The starting point of the framework is the fundamental question of why financial statements are prepared in the first place. In other words, what is the point? The answer given is as follows. The objective of financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors and lenders in making decisions about providing resources to the entity. The framework goes on to explain that these decisions may involve the buying, selling or holding of equity or debt instruments, as well as the provision or settlement of loans and other forms of credit. The practical implications of this statement are easily found in many standards. As an example, let's take IAS 40 investment property, which permits companies to choose between two measurement models, the cost model based on the price that was historically paid for the asset, and the fair value model, which relies on an estimation of the asset's current market value. IAS 40 makes it possible to change the selected measurement approach from the cost model to the fair value model, but not the other way around. It is important to appreciate that this limitation may be traced back to the objective of financial reporting as provided in the framework. Linking the carrying amount of investment properties to their fair values is deemed more useful than presenting those assets at cost. If the fair value model has already been adopted, then going back to the cost approach would definitely reduce the usefulness of information provided by the financial statements and is therefore prohibited.